Welcome back, traders and investors. We have a very special guest on today, Doug Huber. He's Senior Research Analyst at Federal Street Advisors, and he has the tough job of identifying, evaluating, and monitoring hedge fund and private equity managers. Doug, how you doing today?
Good, thank you. How you guys doing?
We're doing okay. A little bit too much snow, but what are you gonna do? Can't do can't do anything about that. Just
No.
quickly before we get into the interview, just real briefly, give us your education and your market background.
Yeah, sure. So I graduated from Babson College up here in Wellesley, Mass. Kind of in the teeth of the downturn in '08, and since then have actually coming out. I got a job here at Federal Street working as a junior analyst covering hedge funds, and subsequently have grown in the role and taken over as lead analyst in the space.
So you're a youngster.
Yeah, not late 20s.
Yeah, you'd fit right in here with all these kids I work with at Benzinga. But okay, so tell us about your firm a little bit, who your clients are, and what they do.
Yeah, absolutely. So we're an investment advisor. We advise on roughly $4 billion. That's non-discretionary, and it's predominantly families and foundations. So we use about 80 client relationships, 75% high net worth, and about 25% foundation.
Okay.
And oh, sorry.
No, I was just gonna say, and so your specific role at the firm is.
So I'm the lead analyst on the alternative side, which is predominantly hedge fund investments. We try to put together kind of concentrated hedge fund portfolios for our clients, about 8 to 12 managers that we recommend widely across the client base. It can be anywhere between kind of 10 and 35% of an allocation, but in practicality with clients that actually use kind of the LP structure, it comes out to about $400 million in hedge fund investments.
Okay, so you look at for this discretionary alternative investment funds, just on the average for the portfolios, you're like you said, 10% to 20%, to give a little bit of different exposure in the market.
Yeah, we view them as complements to existing asset classes. We have a core equity and a core fixed income bucket, and we look at hedge funds as complementing those, reducing risk while being able to kind of put up return in line.
Okay, and do you file commodity trading advisors as part of this?
We don't do anything in that space, and not because we have an issue with it per se. We tend to prefer kind of security selection, fundamental bottom up. It's to us, it's a process we can evaluate, and it tends to get a little grayer when there's kind of thematic or trend following type things going on. So it kind of precludes us from CTAs, macro, quant, things like that.
Okay, and on the average, I mean, there are fees. I mean, are there set fees for these alternative investments as well as incentive fees?
Yeah, generally it's kind of 1 to 2% on the set management fee side, and kind of 15 to 20 on that carry performance side. Although I think, given performance over the last 5 years, there's increasing pressure from investors to kind of keep those fees at bay. I think it's been a lot harder to justify them in the recent past.
Okay, so I mean, is that of the hedge fund? They've kind of been disappointing here versus the overall market? I mean, pretty hard returns to beat in the overall market. Has it kind of been like, hey, we should have had that other 10 or 15% in equities now? Is that the way people are feeling?
I think, listen, you look at last year, right, and equity markets up mid-30s, right? Anything that wasn't long only equity was kind of an opportunity cost to a portfolio. That being said, I mean, as advisors, we can't try to time the market. So I think, there's that part of it. I think, running a hedged equity book, whether it's, 70% net or 10% net is tough, right? I mean, the last 5 years, correlations have been higher, dispersion's been lower, and so you're ending up with a netting game, and to add value from both sides has been more difficult. I think the fortunate thing we're seeing is in Q4 of last year and kind of into the first part of this year, we're really starting to see alpha on both sides of the book again, which is interesting. I mean, it's knock on wood, that's a very good thing, and I think hopefully we'll have a great run. But it definitely has been a tougher 5 years to keep up with just such a bull market.
Okay, so do you tend to, I mean, do you put a just like a set amount with a hedge fund, and then you just keep that amount, and you say, hey, we're going to give them, 1 year, 2 years, 5 years, or whatever, or do you try and give them X amount, and then, after a year, if you have X amount of profits, do you pull them out, or is it kind of like do you reinvest it, or do you try and get your money, your original investment out of them?
I would love to say it's as easy as set it and forget it, but I think we look at it from a portfolio perspective. When we do a lot of work up front to be comfortable with our managers, we don't like turning them over. It's too much of a cost on our end, both at the client side and both for our time. So, to us, it's once we approve a manager, it's approved, and we try to recommend that broadly. So let's just say that it goes into everyone's portfolio. We try to keep them fairly equal weighted. So the rebalancing will tend to be at the points where it becomes an outlier, whether because it hasn't performed and everybody else has, or because it's outrun everybody else. I think during this whole process, whether it's a year, 2 years, or 3 years, we're constantly evaluating the managers, and if something goes off the tracks, whether that be a style drift, key man or leaving, things like that, we will pull. But for the most part, we try to only rebalance whether within the portfolio something's going awry, or in the broader portfolio mix that, equities have run a lot, so we'll probably pull some from our long guys and reinvest back into the hedge funds to keep them at a weight that our allocation determines.
So, how many different funds and hedge funds and alternative private equity firms do you cover right now?
It depends on your definition of cover. I mean, I think last year I did 236 meetings with different managers. This year probably on track to do even more. I mean, on our platform, we keep it pretty tight. We have about 12 recommended managers, but it's not just like logging on to Morningstar and searching a large cap growth manager. You really have to meet these guys. You really have to kind of hit the pavement. So it's a lot of meetings. We cover a lot. Our process and kind of our preference leads us away from we can weed out part of the 10,000 plus manager universe, but there's still a lot of long short equity and kind of long short credit guys out there that we try to take meetings with, kind of build the best ideas list, and have guys on the bench if something were to go wrong.
And what is your like main criteria for when you're looking at these guys initially, and then what are you looking for after you place funds with them?
Yeah, sure. So I think in identifying them, we're looking for kind of the fundamental security selection. But when we evaluate, we're looking at the people in the firm. Is the team there that's kind of made that track record, the investment strategy, and that's probably the most important. We really want a sound process that can stay in place so that we can use kind of the past performance to determine, or at least have a good idea of what future performance should look like. Obviously, there's the quantitative part of the actual performance, and then we're going to go through the back office and look at the operations and things like that. And I think the ongoing monitoring is a mix of analyzing the returns and kind of the alpha, as well as looking at attribution. We're looking at their nets and grosses, making sure if, we're invested with a guy who we think is going to stay between 30 and 40 net, and, we wake up one morning and he's running, levered long, there's probably something going on there. But we do kind of quarterly calls at a minimum, at least one visit a year. They're in here a lot. We're looking at their letters, the filings, things like that to keep the ongoing analysis going.
All right, so if you're getting, if someone is not really performing well, do you follow them for another quarter? What kind of leeway do you give them, or is it just someday you wake up and you go, man, that guy did that, and boom, you boot him out immediately?
Yeah, it's definitely the hardest part of figuring out, what we're going to do. That, when things aren't going your way, it's tough. I mean, it's hard to say what the tougher of two evils is. Is it kicking out a guy that is just having a tough time, that has stuck to his process and should rebound, and you boot him too early, or is it staying with a guy who there's something wrong and you're missing it? So we try to do a lot of work when there's underperformance and trying to figure out what that is. Is it just a headwind to the strategy? We had one last year that just he because of the nature of the product, he happened to be long cyclicals and short defensives in Asia, and it just was a tough bet to have on. And it wasn't because he was making some macro bet; it was because he was kind of a value guy, and there was a flight to quality, and things got expensive on the defensive side and really cheap on the cyclical side. Except that trend just kept hurting him and hurting him and hurting him. And what we figured out was, if you were to back things out, the stock selection really still was there. It was just a headwind. So we were able to stay in and get some rebound in performance.
Wow.
So, it really is, you have to do a lot of evaluation when things aren't going your way. I mean, listen, there's hard stops too, right? If you're starting to lose senior team members, if strategy's drifting, things like that, then we will certainly pull the plug.
Okay, and so over the last 5 years, I mean, I'm assuming that these alternative investments in hedge funds, this is with the performance that the markets had, I've assumed that they've lagged the broad market's performance.
I would say fairly broadly, that's probably accurate. I think I'm just looking across a list of guys we track, and the best performers are kind of in line. 27, 25, that range over 5 years.
Okay.
For the most part, we're looking at kind of mid-teens annualized over the last 5 years. I think while that number sounds tough when you're looking at 23 to 25% annualized returns on equity indices, these guys were doing it running 30% net. So I mean, if you just want to back it out on an exposure adjusted basis, while it was a drag, a lot of these guys put up major alpha. If you're just looking at it saying, at 30%, these guys should be up 7.5, not 15. So it is there, and it's tough to explain. I mean, I think we're committed to the space, and I think these strategies will outperform again, but there was a lot of headwind over the last 5 years.
Okay, and just quickly explain that you said the 30% of net. Could you just explain what that term means?
Yeah, sure. So, on the hedge funds, they can run long and short. So let's just say, the 100% of their capital is running long equity, and they're running 70% short equity. Their net exposure there is about 30% to the market if you just looked at it from an exposure basis.
Okay, and then just I know it's hard to name specific names, but just over the last few years, what sectors have been the best performing funds, and kind of what have been the laggards?
Yeah, I mean, I think from a sector perspective, tech and healthcare have been huge. There's been some beta in the space, and B, I think there's been actual kind of dispersion, winners and losers too. So sector guys in healthcare and tech have done pretty well. I think guys who are able to pick their spots and stay in, they'll take their lumps in the interim, but I think over the period have done really well. The ability to stay into a thesis has worked pretty well. We've seen growth certainly has outperformed some of the value guys on a 5-year, that's for sure. Over the last couple of years, it's a mixed bag. It really has been stock selection. So I think people with a little bit of a longer net exposure, having more exposure to the market, less shorts, I guess, certainly did better last year. It wasn't as much of a hindrance to the portfolios.
Okay, and just before you start looking to alternative investments, I know I've done some things with some CTAs and things like that. What would you look at for an average individual's portfolio before they should start considering these kind of investments? $1 million, $2 million. I mean, where do you feel that it would be, prudent to start, having a little bit more exposure to these funds?
Yeah, I think there's hard limits and regulations, so you have to either be an accredited or qualified purchaser. So you either have to have, I believe it's $2 million now as an accredited and $5 million as a qualified purchaser. So those are kind of hard limits right there, and that's assuming the funds offer certain share classes. But to us, we'd like to be able to offer it as far down as can be allowed. We really do believe in the space, and sometimes you have to kind of have fund-to-funds type aggregation vehicles to give access to smaller asset pools. But we think it makes sense, for anybody that can do it. I think that the important part is kind of viewing it as an overall portfolio context and not just as a separate asset class, because it really isn't. I think we look at it and say, what is this adding? And over time, we believe it'll reduce the risk of the overall portfolio, especially in an environment where bonds probably aren't playing the role they traditionally have. And we think, over time they can do equity-like returns. You just need kind of a broader cycle where there's a little less, where stock selection matters a little bit more.
Okay, and this one, I don't know if you're going to have a good answer for or not, but you obviously have a, exposure in following the investments in some of the, the biggest hedge funds and private equities funds that there are, and you see the way that they're allocating stuff and versus long versus short. Do you ever get signals from the for the overall market when they start to get heavily loaded, a little bit, I mean, obviously they're hedge funds and they're supposed to have an equal balance, but, is there ever times, I mean, like, with this market, we've like had a major run up here. Are there any times that you get, just by seeing their allocation shift, do you ever get cues from, for the overall market?
Yeah, I think you can. It's been tougher. I think some guys, it's been such a run that, they're starting to see valuations where shorts just become more and more and more attractive. But, they were saying that in the beginning of 2013, so I don't think that was the best signal then. I will say that, over time, they tend to move their books on the margin, definitely in favor of kind of what might be coming up. I mean, they certainly talk to the companies. They're hearing what management's saying about kind of the upcoming environment. And so, as they start to shade things based on their conversations there and based on valuation, I think, you can definitely take signals from that.
Okay, we've had Doug Huber on the Federal Street Advisors, who has the very tough job of managing and evaluating hedge funds and private equity funds. Doug, thanks for coming on and giving us your outlook on these investments, and we'd certainly like to have you back on again.
Thank you, guys. Appreciate it.
Okay, have a good day.
Bye-bye.